Hi there, welcome to our Pellegrini Financial first quarter market update call for 2026. And obviously, I ended the year last year, 2025, talking about a market that had been strong for the past 2 years and kind of a continuation of those markets here through 2026. And it started that way. And then the month of March came and the Iran war came in particular that caused a little disruption to the markets as a whole. And so when we look at some of the market's performance, and generally speaking across the globe here, I highlighted the top here, the in the green, the TSX and the small cap in particular was one of the strongest performers in Q1, close to around 9% return. The Nikkei in Japan also was a strong market at 6%. The detractors was basically the tech heavy NASDAQ or the tech sector in general. And that was really concentrated in the month of March. Markets broadly were good up until the end of February, and the Iran war came, and of course, the tech stocks in particular took the biggest hit from that situation in Iran. And as a whole, they rebounded very sharply in April, to be honest. So when you look at kind of where markets have rebounded since the 1st of April, it's been led by technology. And I kind of comment there on the earnings growth rate that's expected through the year on the tech sector. A lot of that AI driven in different ways as AI is driving many other sectors of the economy. It is very productive in the sense of, like I said, driving earnings growth, driving profitability, and that is going to be more and more and more throughout the different parts of the economy. When we look at the other sectors and the other markets in general, I should say, the S&P as a whole was down in Q1 by about 7%. And again, the UK was kind of flat. Euro stocks was down 5%. And so there's a bit of a mixed bag between the other markets. When we look at the Canadian sectors in particular, again, energy at the bottom there, highlighted in green, that's a 30% return on the quarter. Again, information technology was the biggest detractor. And again, a mixed bag between the different sectors, financials being negative, materials being positive, and consumer staples being positive. So you have a mixed bag kind of performance across those different ones, but we've seen the main drivers and the main detractors. When we look at kind of where interest rates and inflation are currently, interest rates, of course, central banks, Bank of Canada, the Federal Reserve, both held rates steady. And the expectation is that most central banks have gone to a more neutral stance, whether they were more policy driven to be rate cutting or rate hikes. That's not what was happening. And obviously, when we looked at where they're going, I think the uncertainty in the whole world situation with Iran in particular, obviously, has gotten them to be a more neutral stance across the board, at least till midsummer. And again, depending on which way things go, that'll dictate a little bit of rate course action. When we look at inflation, it's still subdued. We had 2.4% here in Canada, and for now, that is where it's at. However, I'd like to have a nice little red arrow going upwards in there because I think the trend is hard for not to inflation to start creeping up again. And as I look at this next chart here, the one here on the left-hand side, lots of different line graphs to it, but it's kind of a 25-year history of inflation. And the blue lines at the bottom are detractors. And we mentioned this many times in the past, of course, but technology has always been deflationary. And you can see that quite predominantly at the very bottom. And other sectors as well, clothing, toys and games, furniture. Those are kind of sectors that globalization of trade, free trade, provided that deflationary. Obviously, if things are going to be coming back to sourcing everyone's own, again, customization and manufacturing, that's going to cause inflationary pressures. But obviously, the top ones there are the primary inflation drivers: healthcare, food, education, shelter. Again, the ones that we're talking about in the news, and quite honestly, the ones they talk about down south as well. Maybe shelter is a bit more of a lesser component there, depending on which state you're in, but they are talking about the same things we are: food inflation, healthcare, and that is expensive. That is driving inflation. Your overall inflation there is that middle dark line, and you see that as a whole, it's been a pretty steady line through the last 25 years. All of those kind of sectors had a little bump in 2020 from COVID, and that is driving from food inflation to shelter to overall. I think where inflation goes, it's hard not for inflation to start creeping up. We've seen the energy disruption, higher gas prices, of course, at the pumps. Those are all going to infiltrate through the economy in some way, shape, or form. And the longer it goes, the worse it will be. I think food inflation is also going to be there because, again, fertilizer costs have been increasing quite dramatically. We've seen urea price here locally double from last fall till today. And so food inflation, I think, will come there in the sense that obviously the cost of fertilizers have ramped up. There's probably a shortage of delivery and supplies to different parts of the world that can't just access it, or if they can, then the cost is expensive. They're going to use less of it, which just means lesser or food production that will decline. And so if you have obviously a lower supply, you're going to have a greater cost and a greater expense. So it's going to drive inflation even on food. Those kind of things I think are going to still crop up as time goes by. When we come to monetary policy, I just commented on this time around because of the fact that Canada's kind of come to the end of their quantitative tightening, and that is like a reduced money supply is like a rate increase. So, and I think I commented here on the Federal Reserve as well because there's a new Fed chair coming into place probably when he's confirmed, Kevin Warsh. At the end of the day, that he's been I guess, a driver of rate cuts over the past, but also he's been a big driver of shrinking the Federal Reserve balance sheet. And so again, even if he gets his rate cuts like he might hope to, and he's only one voting member, so it's not like he can drive the whole policy. But his intention is also to shrink the balance sheet of the U.S. Economy, and again, that will really offset any rate cuts they do come into play. And lastly, again, the disruption of the Strait of Hormuz on the oil side and the energy supply side is big because it is, again, the longer it's drug out, the worse it will be in regards to eliminating supplies of oil and energy and other phosphates or fertilizers, helium and things like that can't come out of the strait. And so that is going to be inflationary no matter which way you cut it. So hopefully that's a resolution that they come up with fairly quickly. We're talking about employment and GDP here. Employment here, this is a U.S. data chart at the right, and it's basically kind of similar in Canada, so I didn't bother putting both up. Payrolls have rebounded recently in the U.S., but as a whole, you know, it's a hit and miss kind of a market. Obviously, there's lots of job cuts in the tech sector. Again, that's somewhat driven by AI replacement. It's been a low hire, low fire environment, and you kind of see that in the numbers where there's positives and negatives to that chart. It's really been a stagnant labor market since Liberation Day, and that's been from last April, obviously. And again, it's same in Canada. And at this point, nothing has really changed that. And at this point, I don't know if that's going to change much at all, especially if inflation creeps up and economies start to weather a little bit under that inflationary pressure. Who knows? GDP in Canada, of course, had I was overestimating my number a little bit in the last quarterly call, but the GDP as a whole through 2025 last year was about 1.7% last year. It's looking to be similar again for 2026 in Canada. Again, it's not in recessionary territory, obviously, but it's not robust growth either. The US has certainly got stronger growth at the moment. A lot of capex spending by the tech companies, data centers. Again, that's going to hit some headwinds as well, just because of capacity constraints. But for the time being, it's some short-term drivers, and that's positive to the U.S. GDP number. Commodities, and again, we had mentioned I was going to bring up oil anyways this time around, but not because of all the dramatic that we had here, but there was a lot of dramatic changes to the oil markets, as you're well aware of, no doubt. But we've seen obviously the price of oil, WTI, Brent, and so on, both basically a 50% increase from where they were trending. So WTI is the top chart. $60-$70 a barrel was where it has been for the longest time. And obviously, when the Iran war started in March, you saw that premium jump up. So, yes, a 50% increase in the price of oil. You've seen that obviously in the gas pumps and so on and so forth. Again, short term trends doesn't get activity ramping up. So I talked about the rig count in the U.S., which has been declining for the last couple of years and hasn't really had an uptick yet, even with higher oil prices. Now, if there's a longer runway to higher prices, that might be incentivizing enough for them to jump back in. But for the time being, you still have a lower rig count even in the US. I do have a bottom chart there, which is kind of shows the peak production or expected peak production in the US market. And again, without good replacements, again, a lot of the shale oil, of course, is short-lived at the best of times, and so you can still dribble out for a number of years, but that is a declining production, and that has been the expectation. Again, some oil production opened up in Alaska and so on, but it's not enough to replace what will be declining. Time will tell whether that kind of chart holds true or not, but certainly it's the expectation of it. When we get into kind of what the outlook is, I think there's a number of different things to look at, obviously, in this year coming up. Obviously, we talk about AI in different ways. That is going to be a big primary driver of many things in the markets. And certainly, investment markets right now are placing a lot of emphasis on AI and being implemented in different ways in different industries, being more efficient, more productive, driving earnings, driving profitability. That is a big scenario. Obviously, the trade talk for USA, Canada, Mexico. Obviously, there's discussions between Mexico and USA already. Canada is not so much at the table at this point. They are, in my mind, I guess, playing a bit more of the long game. And, certainly the US is going to say they always hold all the cards. I don't think they do hold all the cards. They hold most of them, but not all. And I think the Canadian side is trying to play the long game. Whether that's right or wrong, I don't know. Time will tell. But that'll be part of what goes on with our markets as well. I think, U.S. elections coming up will also cause changes to how things operate. Who knows what direction they go, but obviously it's skewing towards the Democratic side at this point versus Republican. Come November, you'll know. The Federal Reserve changes, Fed nomination. I think there's a few things that could change there. I mean, the new Fed chair, if he is nominated and confirmed, then the changing metrics and how they measure inflation down there is more in line with what they do in Canada right now. If that happens, that's fine. Shrinking of the balance sheet, I think, will be a big thing that could influence, obviously, the fixed income markets to some extent. And the federal debt that's mounting up in the U.S. It is 10 trillion of debt moving over this year in the U.S. and we've been through a quarter of that already, and another trillion of debt being added every 6 months or so based on their current spending. It is enormous and unheard of, but it'll be interesting to see whether the market still bid for U.S. Treasury bills. If not, then there's a rising rate environment that has to be bid up in the auctions. Obviously the Strait of Hormuz and the Middle East situation is ongoing, and it's hard to comment on where that goes exactly. The longer it goes, however, the worse it is for inflation, for energy supplies, and so on. Again, we've already lost $400 million or 400 million barrels of production that's been shut in out of the Middle East. You just can't get that back. And the longer it goes, the more barrels that pile up that you've lost. I mean, yes, production can be ramped up again once it's all done, and we build some infrastructure and so on. But again, those are just you can't get back what you lost, and so that's going to impact more certainly emerging markets in particular, which I commented at the bottom there. Obviously, it impacts Japan, UK, Euro in particular because they import more of it. Canada really doesn't have an impact necessarily. Obviously, we pay higher at the gas pumps, and the US for the most part is unchanged. But that is obviously something that's out of all of our control, and markets have dealt with wars in the past, and they'll deal with this one as well. And I think globally, I mean, everything still remains somewhat prospects of a positive momentum. Again, it's going to be a little contingent on what happens with Iran, energy costs, and so on and so forth. Um, and so those are things I think that are shifting as we're speaking, to be honest. And but as a whole, um, the tech sector, AI, and everything else that's been driving the economies across the globe in different ways and improving industries is going to continue. And we see that as probably some of the positive momentum behind things. And so we'll leave it at that for now. We thank you for joining us in this Q1 talk, and we look forward to you in Q2 in a few months' time. Bye for now.